There's your M top on Bitcoin. So what we see here is that the two types of tops are as follows. So you have the M top where you make a slightly higher high. Now, why do all of these make a slightly higher high? They make a slightly higher high because you have to lure in the last people on the sidelines. And if you don't take out the previous top, like here you took out the top, which made everyone thinking, oh, it's going to be a double top, they got lured in right here and they covered their shorts and they went long. This is a classic pattern. The market wants to make you flip the lid, essentially, and then it tops out and pulls the rug. And so that's exactly what we saw in 2007. The other scenario could be something like you saw on the Dow Jones Industrial Average in the different points here of, let's say, the Great Depression, right? So if we go all the way back here, and I'm just going back decades and decades here, but if we go back to the period here, this is your other type of top. All right, so your other type of top is you have the down move, you then have the retrace, which is significant. In this case, you fell 51%, you retraced 40, basically 50-50, right? You fell 50, you retraced 50, and then you had the big decline. Now, right now, if we go back to the NASDAQ or the S&P 500, if we look at that, we're still in that first one. We're still here. We're not at the highs. So here's your pivot high down. Here's your retrace. So the question is, are we going to continue and take out this high by a fraction before that rollover occurs, or are we going to roll over first? Okay. All right. So just a couple little tidbits there I wanted to show you guys real quick. Couple other things on the charts that I want to go over here real quick as well. Let's go into the crypto markets and see what the crypto markets have in store for us. Now, this is a kicker, guys. I showed you guys this last week when it was early on in the bear flag. This now is a mature bear flag. In addition, you have a time count. Time counts are powerful signals. They're timing factors that repeat over and over. In fact, if you go into the time count that I use is the 7 factor. And you could go through any religious text. You can go through almost anything, 7 days in a week, the 7 deadly sins. You could go. There's things that in human nature repeat over and over again, and they repeat in charts over and over again. So just to give you a sense of this, right? So you could look here, right? Pivot low, 1, 2, 3, 4, 5, 6, 7. All right, here, 1, 2, 3, 4, 5, 6, 7. So the idea is that nothing's written in stone. It doesn't mean it's a guarantee. But what it does mean is that in general, bigger moves or significant periods tend to occur on a 7 point.
Hello and welcome to Money Talks. In today's video, Gareth Soloway gives us an update on his current macro thesis and his perspective on current global market conditions. Also his prediction for Bitcoin and crypto, and where he thinks the market will go in the next months. So let's get started with the video.
All right, so this is bearish. The idea is you likely are going to have a down move. I think your max downside right now remains at 27,000-ish, give or take. It's an upsloping trend line. Nothing really has changed from last week on that chart. Now, I am keeping an eye on Matic. I think Matic is starting to break lower here. All right, we've broken below this flat line right here. That's problematic for Matic. But again, we're looking at another support probably in the 65-cent range. All right, so there are opportunities here. Let's just go over ETH real quick. Then we're going to flip into some commodities out there as well. We also should look at the US dollar as well. And by the way, I didn't even mention this. In fact, let me talk to this screen right here. I didn't even mention this yet, but last night, Japan came out with a bond buying program. Now, what's nuts about this, guys, is that just last Friday, on Friday, they came out and were like, hey, we're going to let our yield curve control loosen a little bit, which means they were, basically they're letting yield float. When a central bank buys bonds, they're doing the exact opposite of that. And so this was almost shocking because to go from one extreme to the other, you know what that tells you? That tells you that the central banks inevitably will always go back to printing of money. And while the U.S. isn't at that point yet, it is going to be at that point at some point, whether it's a year from now, 2 years from now, or who knows when. But it will get to that point. All right, so again, doesn't mean their yield curve. I think what ended up happening, to be honest, just to be flat out with you guys, is My guess, yield started to jerk up too much, and so they didn't want too big of a move initially, so they kind of had to do some bond buying to bring that back into check. But I do think that they are trying to loosen it because inflation is everywhere, folks. I've showed it to you. And then, by the way, let's go back to this chart here. And again, sorry to get off of Ethereum. We'll go right back to it. But would you look at this? This is oil just today, folks. This is oil from the beginning of July. All right, so yeah, you want to tell me inflation's not around anymore and it's going back to sub 2%? Okay, let's be real. All right, gasoline, you want to see what gasoline's doing today? We'll go back to Ethereum real quick. I don't mind. That's your gasoline for the month of July. So you're looking at month-over-month numbers spiking. Okay, this is inflation is going to be stuck at 3%, give or take. Doesn't mean it can't go to 2.9, 2.8, whatever. But I'm going to tell you right now, it's not going sub 2%. I said this for 6, 12 months. It's going to get sticky here. 9 to 3, that's like me getting in shape. You know what the hardest thing for me to do when I get in shape is? Get my six-pack. That's the equivalent of going from 3 to 2, to finally get that little six-pack. Hard for me to do personally, just the nature of it. But again, it is what it is. All right, last thing, let's go to Ethereum. In fact, we'll go over the metals charts quickly as well because I do think the metals are important. Ethereum here, folks, bearish consolidation. You've been in a general downtrend. This is your down target, 1750. I would continue to expect 1750. And by the way, it doesn't mean we can't go higher. And like I said, with the Fed going back eventually to printing of money with what we see in Japan, eventually we're going to see Bitcoin and Ethereum rocket. All right, eventually these things are going to go. Is the 4-year cycle in stone? I think people that are adamant that, oh, it's a 4-year cycle, they're new investors. That's just the nature of it. You know, when you trade a market for 20 plus years, and I had about 10 years prior of trading experience before Bitcoin was even invented, you start to realize that cycles, the trust in cycles needs to be a lot longer than essentially 14 years, right? And so you have 4-year cycles when the Fed is printing money, and then you have question mark when the Fed's not. And that's what we're in right now. And that's why, honestly, I don't trust the 4-year cycle right now because, yeah, you have the halving next year, which may be good, but everyone's banking on it, which makes me right away skeptical. And that's always something to remember, folks. When everyone else is saying something, it usually doesn't happen. But also just remember, if the Fed is not printing money, at least in this point, the cycle could be elongated. The bear cycle could be elongated.
Inflation came down a lot faster than most investors and analysts anticipated, reaching 3% in June. The recession that most analysts predicted is nowhere to be seen, according to the 3.6% unemployment rate nearing a 50-year low and the S&P 500 index showing a 19% gain year-to-date. While the current market performance may lead investors to believe that a recession has been avoided, there are 3 metrics that have been able to consistently predict recessions over time. These leading economic indicators are key economic variables that tend to move ahead of changes in overall economic activity, providing an early warning system for changes in the business cycle. Let's dig into 3 of these indicators and explain how investors can interpret them. The yield curve represents the relationship between short-term and long-term interest rates on government bonds. Normally, long-term bonds have higher yields than short-term bonds to compensate investors for the risk of holding their money for a more extended period. Historically, an inverted yield curve has often preceded recessions. This indicator suggests that investors are worried about the near future and expect interest rates to fall due to a potential economic slowdown. The 2-year Treasury yield is currently 3.25%. While the 10-year Treasury yield is 2.95%, typical of periods ahead of a recession. However, that has been the case since September 2022, and historically, there's a 9 to 24-month lag before the economic contraction takes place. The U.S. economy is currently presenting mixed signals. Despite a robust consumer demand underpinned by rising wages and low unemployment, industrial growth indicators have remained weak throughout 2023. Moreover, bond markets suggest market reluctance to add risk-on positions. This hesitancy is due to the Federal Reserve's anticipated monetary policy tightening and further expected interest rate hikes for 2023. These different signals show the tricky situation for those in charge of the interest rates. If the Fed tightens policy too much, it could slow down the economy too quickly, possibly leading to a recession. On the other hand, if the Fed is too lenient, it could trigger high inflation, which erodes purchasing power and can destabilize the currency. For cryptocurrency investors, there's an additional variable that further complicates the analysis. Despite the long-term high correlation between Bitcoin and the stock market, the past 8 months have displayed periods of inverse trend, meaning the assets moved in distinct directions. Amid crypto market uncertainty, the Fed's decisions are key to revealing economic confidence. Increasing interest rates signifies stability, potentially benefiting cryptocurrency markets in the short term, whereas rate cuts may indicate economic concerns, possibly affecting risk-on markets in general. Therefore, tracking the Fed provides timely investor guidance in uncertain economic times. So, what's your price prediction for Bitcoin at the end of 2023? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.